Hey guys, today we're going to talk about something that confuses a lot of people, but it's really important to understand. And that is how your Social Security benefits are calculated. So, if you've ever wondered how the Social Security Administration decides how much you should be getting every month, it's not random. There is a very specific formula that they follow, and it is mostly based on your work history. Today, we're going to break it all down in simple English so that it's easy to understand. And I hope that you'll join me on this discussion because there's a lot of really important information here. But first, I want to remind you that our sponsor chapter is giving away their #1 Amazon bestseller on Medicare for free to the low income relief audience. You just have to visit the link that you see on screen there in the yellow, and you can download your copy of that book right away. Now, of course, you already know that Social Security is a government program that provides monthly income when you retire or become disabled. You pay into it with every paycheck through payroll taxes. And the more you earn and the longer you work, the more you can get. That's the easy part. What happens behind the scenes at the Social Security Administration as they calculate those benefits is a lot more complicated. And we're going to walk you through that process today so that you can understand what's going on with your benefits. And the first thing they're going to do is look to see if you qualify based on your work credits. For retirement benefits, you usually need 40 work credits. You can only earn 4 per year at the most. So that's at least 10 years of work. For disability benefits, the number of work credits that you need to have may be less because it depends on the age where you became disabled. Younger workers obviously don't need to have as many. SSI, or Supplemental Security Income, is a completely different program that is based on your income and your resources, not your work history. You do not need to have any work credits to get SSI. However, the calculations for that program are completely different than they are for standard disability or retirement benefits. So, we are not going to be diving into the SSI calculations today. If you would like me to make a separate video on that for you, I would be happy to do that. Just let us know in the comments and our team will get to work on that for you. Now, after they've gathered all of your earnings data, what they're going to do is index your earnings. And that sounds really complicated. And honestly, I looked at some of the calculations involved, and it is complicated on their end. But what you need to understand is that when the Social Security Administration is calculating those retirement or disability benefits, they're not just looking at the amount of money that you actually took home. They adjust your past wages to reflect current changes in the National Average Wage Index. That means that if you earned, say, $20,000 in a year in 1980, you're not going to be unfairly penalized or get less, even though that same work may have paid $20,000 today, right? They understand that the value of wages and the overall standard of living have changed. And so that's the purpose of this indexing adjustment, is to make sure that they kind of level all of that out. So, like I said, indexing is a very complex calculation. If you're interested into diving into all the nitty-gritty details on that, you can find the information on the Social Security Administration website. But honestly, it was complicated and I didn't want to bore you with all of those details here in this video. So, once they have done that and they've indexed all of your income, then they look at your highest 35 years of earnings. So, the 35 years where you earned the most money. Now, if you worked less than 35 years, they're going to fill in those blanks with $0. That's why even part-time work in later years may raise your benefit payments. This is also why people who work maybe under the table or in unpaid positions or didn't have as much taxable income don't get as much in their Social Security benefits. Now, one thing you need to remember is that disability and survivor benefits can use fewer years than 35. Obviously, if you became disabled before you had 35 years of work, it's not really fair to be penalized for the years that you were unable to work because of your condition. As it sits, you're already getting less because that disability probably stopped you from what would have been your highest earning years. But the general idea still applies here. They're going to choose your highest indexed years in calculating your benefit. And we'll go over in just a little bit here how many years count and how they decide that and so on. So if you're interested in disability benefits, just know that the bulk of what we're going to discuss today still does apply to you, with a couple of minor tweaks. And we'll be going over all of that here very shortly. Now, the next thing they're going to do is use that information to calculate what's called your AIME. That's your average indexed monthly earnings. So once they know how many years they're taking into account and what those indexed earnings are, They add up the total value of those earnings, divide it by the total number of months that they're using, and then round down to the next round down to the next lowest dollar. The result is your AIME amount, but we're not done yet. So just stick with me. There's a couple of other big things that can affect the total amount you'll receive. So just as an example here, let's say you're looking at your total indexed earnings over a 35-year period, and it comes out to be $1 million. You divide that by 420 months because that's how many months are in 35 years. And that gives you an AIME of about $2,380 a month. That number becomes the starting point for figuring out your monthly benefit. So the next thing that they do is calculate what's called your primary insurance amount. This represents the total amount that you would receive if you retired at your normal retirement age. Now, there is a really complicated three-tiered calculation that they use here. It's not a flat percentage. And the tiers are based on what's called bend points because of how that graph looks. And you can see it there on screen. It kind of goes up, and then it bends, and then it goes up, and then it bends again. Those bend points make sure that low-income earners get a bigger percentage of their income replaced than people who earn more money. So in practice, this is how it works. And these numbers are for 2025. I know these numbers are about to be adjusted for the upcoming year, but you'll get the point from this. So you get 90% of the first portion of your income. And right now that's going to go up to the first $1,226 a month of your AIME. And then for the second portion, you get 32% of your AIME that's valued between $1,226 and $7,391. That's that second bend point. If you have earnings over that top bend point, you only get 15% of those. So with our example that had an AIME of about $2,380, you're going to get 90% of the first portion of that and then 32% of the second portion of that for a total primary insurance amount of $1,472 at full retirement age. Hopefully that makes a lot of sense. I know things can get a little bit confusing when you start getting into exact numbers there, but I wanted you to see how this works in practice because I think that's really important. So then they also need to adjust it for either early or late retirement, depending on when you're taking that retirement. So you can collect Social Security retirement as early as age 62, but that comes with a compromise. You will always receive about 30% less than you would have if you had waited for your full retirement age. That amount, and this is a common misunderstanding, that amount is not going to increase when you reach your full retirement age. You are agreeing to a permanent reduction to get those benefits earlier. And you really have to evaluate whether or not that's a good choice for your circumstances. As we're going to discuss in a minute, there really is no one-size-fits-all answer to that question. Your full retirement age will be somewhere between age 65 and 67, depending on your year of birth. You can see the chart there on screen. Hopefully you can open that up big enough that you can zoom in and see it really clearly. Now, if you choose not to retire and you decide to delay that longer, you can add an extra boost to your retirement benefits that is worth up to 8% per full year that you delay. But that is only until age 70. If you choose to wait after age 70, there are no additional boosts that you can get after that time. Now, let's look at how this works with our example. So if your primary insurance amount was $1,472, like our example was, you would be looking at getting $1,030 a month at age 62. That's roughly 30% less than you would have been expecting. At age 67, you could get that full amount. And if you waited until age 70, you could get an extra boost that would bring you to about $1,850 per month. And again, these are all based on 2025 numbers. Now you can see here that timing makes a really big difference. The difference between age 62 and age 70 there is over $800 a month, and that is substantial. So it's important to make sure that you make that decision really carefully. Now, you already know there's a ton of conflicting guidance online about when you should take those benefits. Many people are choosing to take them now because they're worried about what might happen when the trust funds runs out, which is expected to happen in the next 10 years. There is no cookie cutter, one size fits all answer to when is the best to take your benefits. There's a lot of pros and cons for each one, and you need to carefully evaluate those when you're making the decision about when to retire. Now, if you're on this video because you're wondering how your disability benefits are calculated, it's basically the same. AARP says that mathematically speaking, SSDI is calculated the same way as Social Security retirement, but they do not have to use 35 years of data. What they're going to do is they're going to count the number of years between age 22 and the time that you became disabled. And depending on how many years are in that span, they're also going to disregard an extra 1 to 5 years. And then however many years are left is how many years they're going to take from your highest earnings to put into the calculation. And once they've finished all of that, when your SSDI claim is finally approved, you will be awarded 100% of your primary insurance amount as if you had reached full retirement age before you stopped working. So that's how disability benefits work. Now, of course, there are other Social Security programs out there too. They've got survivor's benefits, spousal benefits, SSI, and each of these programs has its own rules and calculations and nuances and all of that. So if you would like us to go over any of those in detail, please just drop a comment and let me know which ones you'd be most interested in. We really like bringing you the information that you care about most. And of course, don't forget to go grab your free copy of Chapter's best-selling Medicare book. It's not that complicated. The 3 Medicare decisions to protect your health and money. You can get your free copy at the link that you see there on screen. And I will be back soon with more ways that you can save money and get free stuff. I'll see you there.